A major war on 28 February 2026 created uncertainty across global markets and affect many countries. In this study, we analyzed 5 multinational companies on Bursa Malaysia: Dialog Group Berhad, Inari Ameriton Berhad, Press Metal, Aluminium Holding Berhad, Top Glove Corporation Berhad, and Harta Lega Holdings Berhad, to see how their stock prices react before and after the event.
This slide provides an overview of Russia and stock market environment. Russia is known as one of the world's major energy power because it exports large amount of oil, natural gas, and other commodities to global market. Due to this strong energy sector, the Russian stock market is highly connected to global commodity price and international political events. The main stock market indicated in Russia is the MOIC Russia Index. This index measures the performance of the leading Russian companies, especially those involved in industrial and energy-related sector. Because many of these companies depend on global trade, the market is very sensitive to geopolitical uncertainty. On 28 February 2026, a major war created significant geopolitical tension and directly affected investor confidence. Since Russia was the center of the conflict, the event caused instability in global financial and commodity market. As a result, investors react strongly, leading to a higher volatility in Russian stock market. Therefore, studying the MOIC Russia Index is important because it helps us understand how investors respond to geopolitical shock and how war can influence stock market performance and economic stability. Alright, moving on the stock market index price graph. Looking at the pre-event period from February 9 to the 27th, the Russian stock market remains stable with gradual upward trend, moving from 2725.64 to 2779.14. At this stage, investor sentiment was normal and the market had not yet fully reacted to geopolitical uncertainties. However, on the event date of February 28, we saw a significant surge to 2835.65, eventually peaking at 288.68 in March, driven by rising global energy price. The index closed the period at 2868.99, maintaining a level significantly higher than its pre-event state.
Now let's look at abnormal return graph. During the pre-event period, on market stability, the market fluctuated with no major shock, staying relatively close to the 0.9. For investor sentiment, the investor appear cautious but stable, with abnormal return remaining within a tight range. For example, data which includes 0.01326 on 11 February and negative 0.00793 on 17 February. The actual returns were generally in line with investor expectation during this period. In the post-event period, abnormal return becomes significantly more volatile immediately following the event date. Unlike other markets, Russia saw a sharp positive abnormal return of 0.01861 on 2 March. The market experienced rapid swings, such as the drop to negative 0.01378 on 10 March. The graph shows a series of sharp peaks and troughs as the market struggled to find a new equilibrium. Next, let's looking at the pre-event period for cumulative abnormal return. The CR remained mostly in negative territory through the pre-event window. The market was building up a slight cumulative loss, reaching negative 0.00813 by 27 February. The investor did not see any prolonged positive movement or significant real gains before the war. Immediately after the war event in the post-event period, the CR dropped its negative trend and turned positive. The CR reached its highest point of 0.02053 on 9 March, suggesting a temporary period of gains following the initial shocks. Following the peak, the CR trend down again, showing that the market gains were not sustainable. By the end of the period, which is 19 March, the CR returned to zero, indicating that all cumulative abnormal gain had been wiped out.
Now we move to the next one, United States. Before that, let me briefly explain the NYSE Composite Index. This index represents all the companies listed on the New York Stock Exchange. It includes many sectors like finance, technology, and energy, so it gives a broad picture of the overall market performance and investor sentiment. Because of this, it is a good indicator to understand how the market reacts to major events. Before the war on 28 February 2026, the stock index showed a stable and slightly increased trend. For example, it increased from around 23,340 to 23,494. This tells us that investors were confident and the market was performing normally. There were small ups and downs, but overall the situation was calm and positive. However, after the war started, the situation changed significantly. The index dropped sharply, reaching around 21,996 in March. This showed that investors become worried and uncertain about the future, leading them to sell their shares. As a result, the market experienced higher volatility and a clear downward trend. Next, looking at abnormal return, before the war, the values were mostly positive, such as 0.00472, 0.00575, and 0.00818. This means that actual returns were higher than expected, showing strong market performance and high investor confidence. But after the war began, abnormal returns turned negative. For example, negative 0.01546, negative 0.01059, and negative 0.00965. This indicates that the market performance worse than expected. Investors react quickly and emotionally due to fear and uncertainty, which caused a sharp decline in returns. Finally, for cumulative abnormal return or CAR, before the war it was positive at 0.03614. This means profit were building up steadily over time. However, after the war, CAR dropped sharply into negative territory. This showed that all previous gains were wiped out, leading to what we call a weight loss effect. To conclude, the conflict created sudden uncertainty in the market. This caused stock prices to fall, abnormal return to turn negative, and cumulative return to decline significantly. It clearly shows how sensitive financial markets are to unexpected geopolitical events.
Germany is the largest economy in Europe, and its stock market is represented by the DAX 40 index, which consists of major industrial and financial companies. Because Germany is closely connected through trade with other European countries and is located near conflict-prone regions, its stock market is very sensitive to geopolitical risk. In this study, we focus on the impact of the war that started on 28 February 2026. The purpose is to understand how investors react to such a shock and how it affects the movement and volatility of the German stock market. Based on the graph, the German stock market was relatively stable before the event, with the DAX index moving around 24,800 to 25,300 points. This shows that investors were still calm and market confidence remained stable despite the geopolitical tensions. However, after the event, the DAX index declined significantly from 25,284.26 points to 24,638 points and continued falling until 22,839.56 points on 19 March. This downward trend reflects investors' concerns about the economic impact of the conflict, especially due to rising energy prices, inflation, supply chain disruption, and recession risks in Germany. Based on the abnormal return graph, the German market was relatively stable before the event because most abnormal returns fluctuate close to zero. This indicates that investors did not react strongly to the geopolitical tensions. However, after the war started on 28 February 2026, abnormal returns became more negative and volatile. The significant negative values on 2 March and 3 March show strong investor reaction and increased selling pressure. Rising oil prices, inflation concerns, energy supply disruption, and the closure of the Strait of Hormuz further increased uncertainty, causing investors to react negatively to the German stock market. Based on the cumulative abnormal return graph, the German stock market remained stable before the event because the CAR values stayed close to zero with only small fluctuation. This shows that there was no prolonged negative impact on the market during the pre-event. However, after the war, the CAR continued to decline throughout the study period and reached negative 0.11052 on 19 March. This indicates that the German market experienced sustained abnormal loss after the event. Rising inflation, recession concerns, weaker business confidence, and expectation of tighter monetary policy further reduce investor confidence and contribute to the continuous decline in CAR.
I will present the impact of the geopolitical event on Iran's stock market using the Tehran Stock Exchange. The Tehran Stock Exchange is the largest stock market in the Middle East and is highly influenced by oil and gas because Iran's economy depends heavily on the energy sector. Therefore, geopolitical conflicts can have a significant effect on market performance. For the first graph, which shows the daily stock market index, the market was relatively stable during the pre-event period, from 4 January to 26 February 2026, fluctuating between approximately 3.6 million and 4.4 million points. This indicates normal market conditions and suggests that investors did not strongly anticipate the outbreak of war. However, on 28 February 2026, the index dropped sharply to zero. This reflects a trading suspension and severe investor uncertainty. After that date, the index remained at zero, showing that the market did not recover during the post-event period. The abnormal return graph shows that before the war, abnormal returns show a large fluctuation, including strong positive spikes and several negative returns as the conflict approached. This pattern suggests increasing instability and uncertainty. On the event date, oil prices surged significantly, causing inflation concern and leading investors to shift from equities to safer assets. After 28 February, abnormal returns remains at zero, indicating that trading activity had effectively stopped. The final graph shows the cumulative abnormal return or CAR. CAR increased steadily and reached about 15.4 by mid-January 2026, suggesting that the market had generated positive abnormal returns before the war. However, after 28 February, CAR became flat and remained unchanged at around 15.2. This indicates that the war froze the market and eliminated any further gains or losses. In conclusion, the geopolitical conflict had a devastating impact on Iran's stock market, causing a complete market shutdown and halting all investor activity.
Next, I will present about Poland's stock market performance during the war event study. Before the event, Poland's stock market was relatively stable and investor confidence was positive. However, after the war event, stock prices dropped sharply and market volatility increased significantly. Investors became more cautious and the market showed unstable movements. Before the event, abnormal returns fluctuated around zero, showing normal market reactions. After the event, the graph showed a sharp negative spike and abnormal returns become more volatile due to increased market uncertainty. For the cumulative abnormal return graph, before the event, cumulative returns were generally positive and stable. However, after the event, cumulative abnormal return declined sharply and remained mostly negative and volatile, showing weaker investor confidence. In conclusion, the war event negatively affected Poland's stock market by increasing volatility and weakening investor confidence.
Okay, on this slide, we are going to talk about the Malaysian stock market, daily market, abnormal return and cumulative abnormal return. Malaysia's main index is FTSE Bursa Malaysia KLCI, and Malaysia also is the world's largest palm oil producers, and in Malaysia, banking stocks dominate the market. This slide shows the movement of Malaysia's daily stock market index before and after the 2026 Middle East War. During the pre-war period, from 6 February until 27 February, the Malaysian stock market remained relatively stable and strong, with the index moving consistently within the range of around 1740 to 1760 points. This indicates that investors were still confident in Malaysia's market performance and economic stability before the conflict escalated. However, after the official outbreak of war on 28 February, the market became more volatile and generally weaker due to rising global uncertainty and investor panic. As shown in the graph, the index dropped to around 1,700 points and even touched approximately 1,670 points at one stage. Although the market managed to recover slightly afterwards, the index continued to fluctuate and did not return to a fully stable range. The second slide shows that the graph of abnormal return. As we can see here that during the pre-event war, the abnormal return fluctuates slightly around zero. This indicates that the stock prices were moving largely as expected and the graph is stable. If investors see this, they will feel very happy to invest in our stock market. However, around the event date, we could see significant changes. Maybe because before the event, there is something that happened that makes our graph declining. After the event, the graph start to show positive changes. Even though it is increasing positively, on 9 March, there was a sudden drop due to global uncertainties. This is not expected, of course. The price dropped drastically. On 10 March, Malaysia come back with a strong changes, whereas the market shows a positive increase. This is cumulative abnormal return, which shows the total abnormal performance of a stock market. During the pre-event, market is in a stable state and no sudden changes. The positive growth gives investors confidence to invest. Around the event date, changes start to occur. After the event, the market is declining and dropped to negative at one point. This triggered a market reaction towards our stock, but of course on 18 March we could see here that the graph shows a partial recovery, and up until now the graph is still recovery and show positive changes.
We will now see how stock prices of 5 multinational public listed companies in Bursa Malaysia reacted to this geopolitical event. First is Dialog Group Berhad. It is a Malaysia-based integrated technical service provider to the energy sector. Let's look at the graphs. First is daily stock graph. Initially stable, Dialog stock halted during the February 28 war announcement. Speculative buying then spiked price to RM2.06 before a mid-March correction, highlighting intense market reaction to external shocks. Let's look at daily returns. Before the event, Dialog was the picture of stability. Then came the February 28 announcement, triggering an immediate trading halt. This graph clearly shows the shift from business as usual to a high-stake speculative environment. Moving to abnormal returns, which strip away general market movement to show how Dialog specifically reacted. Pre-event deviations were tiny, mostly tracking market expectation. On March 9, we hit a 10% of positive abnormal return, a massive overreaction to geopolitical risk. This tells us that the initial price surge wasn't just market growth, it was a specific intense investor reaction to the war. The cumulative abnormal return shows the big picture impact. Adding up to the war, we saw a steady climb to 11%, showing a strong organic optimism. Post-war, the graph spiked due to a speculative buying. Investors anticipated that pengerang deepwater terminals would become more valuable during a global supply crunch. Finally, let's look at risk. Our standard deviation jumped from 2.62% to 3.38% after the war, confirming that the stock became significantly riskier and more erratic. But the most fascinating change is in the beta. Pre-war, Dialog was a conservative play with a beta of 0.606. After the war, it plunged to negative 2.17. It means Dialog started moving in the opposite direction of Bursa Malaysia Index. Investors essentially used Dialog as a hedge. When the broader market crashed due to war fears, they pour money into Dialog as a safe haven for energy storage. This explains that drastic swings in the market sensitivity.
In this study, the selected company is Inari Amatron Berhad, a Malaysian company in the semiconductor industry that provides assembly and testing services for electronic components. The company operates internationally in countries such as the Philippines, China, and Singapore. Inari is involved in wafer packaging and optoelectronic modules used in smartphones, automotive electronics, and communication devices. Since the company relies heavily on global supply chains and international markets, it is highly exposed to the geopolitical risks, making it suitable for analyzing the impact of the 2026 war event. Based on the graph, Inari Amatron's share price was relatively stable before the event, moving around RM1.50 to RM1.53. This shows that investors were still calm and not reacted strongly to geopolitical risks. However, after 28 February 2026, the stock price started to decline and became more volatile. The price fell from RM1.42 on 27 February to RM1.37 on 2 March and continued dropping to around RM1.21 on 9 March before slightly recovering. This decline was mainly caused by global supply chain disruption in the semiconductor industry. Higher transportation costs, logistic disruption, and limited access to raw material weakened investor confidence and increased selling pressure on the stock. From the daily return graph, Inari Amatron Berhad's returns were relatively stable before the event, fluctuating within a small range of around negative 1.96% to positive 1.96%. This indicates that the market was still calm and investors did not react strongly during the pre-event period. However, after the war, daily returns became more volatile with larger positive and negative movements, including significant drops of around negative 5.96% and negative 5.07%. This shows that investors' reactions became more sensitive after the conflict began. Overall, the geopolitical tensions increased market volatility since Inari operates in the semiconductor industry and depends heavily on global supply chains. its stock's return became more affected by market sentiments and external shocks. This abnormal return graph shows the difference between actual shocks returns and expected returns, which is used to measure abnormal investors' reaction to the geopolitical event on 28 February 2026. Before the event, abnormal returns were relatively stable and close to zero. This indicates that the stock was moving in line with market expectation and there was no major disruption in investor behavior. However, after the event, abnormal returns became more volatile and negative, with larger deviations reaching around -4% to -5% in early March. This shows a clear gap between actual and expected returns, reflecting a strong negative market reaction. This can be explained by global supply chains, disruption in the semiconductor industry, including shortage of key materials like neon gas, higher production costs, and delivery delays. As a result, investor confidence weakened and Inari experienced stronger abnormal movements after the war, showing increased market shock.
Next, we move to cumulative abnormal return or CAR. Before the war, Inari showed strong performance supported by 1 cent dividend announcement, which reflect management confidence. However, despite this positive signal, investors had already started to feel uncertain due to rising geopolitical tension. This is shown by a negative CAR of -5.7% even before the event. After the war was declared, the situation worsened significantly. CAR dropped further to -12.98%, indicating a sharp decline in the shareholder value. This suggests that investors view the conflict as a serious risk, especially due to potential disruption in global supply chains and increased uncertainty in the semiconductor industry. Next, we look at standard deviation, which measure price volatility. Before the war, Inari's standard deviation was relatively low at 2.05%, indicating a stable and predictable trading environment. However, after the war, it increased sharply to 3.5%. This showed that the stock became much more volatile as investors react strongly to the political instability. The increase in volatility also suggests panic-driven trading and difficulty in determining the company's true value during uncertain times. Finally, let's examine beta, which measures how sensitive a stock is to overall market movements. Before the conflict, Inari had a high beta of 2.63, meaning it was an aggressive stock that amplified market movements. After the war, beta dropped to 1.27. Although the stock remained volatile, it became less correlated with the overall market. This indicates that Inari's price movements were increasingly driven by firm-specific and industry-specific risks, such as semiconductor supply issues and geopolitical disruptions, rather than general market trends.
Next, I will present the impact of the war event on Top Glove Corporation Berhad. Top Glove is the world's largest rubber glove manufacturer, founded in Malaysia in 1991. The company exports its products to over 195 countries and produce medical, industrial, and household gloves. For the daily stock graph, before the event, Top Glove stock price already showed a decline trend, decreasing from around RM 1.21 cents to 93 cents. This indicates that investor confidence had started to weaken even before the war event, although the market remained relatively stable. After the event, the stock price dropped further to around RM 85 cents to 90 cents and became more volatile. However, there was a slight recovery at the end of March. This decline was mainly caused by weak glove demand, industry oversupply, and investor uncertainty. For the daily return graph, daily return fluctuated near zero before the event, but there was a sharp negative return around -0.14. This suggests that market sentiment had already started weakening before the event occurred. After the war event, returns become more unstable with frequent positive and negative spikes. Investor reactions also become more uncertain due to weak demand and oversupply in the glove industry. For the abnormal return graph, abnormal return fluctuated around zero before the event, showing relatively normal market conditions. However, a sharp negative abnormal return was recorded during the pre-event period. After the event, abnormal return became more volatile, fluctuating between negative 0.05 and positive 0.05. This indicates that investors became more sensitive and reacted strongly to market uncertainty. For the cumulative abnormal return graph, CAR showed a downward trend before the event, indicating that accumulated loss were gradually increasing and investor confidence had weakened. After the event, CAR briefly rebounded to zero on 28 February but declined again afterward. Overall, CAR remained negative and volatile, reflecting continuous uncertainty and selling pressure in the market. For the standard deviation graph, volatility before the event was higher at around 3.71%, indicating larger fluctuation in stock returns and increasing uncertainty. After the event, volatility decreased slightly around 3.07%, suggesting that stock returns become relatively more stable compared to the pre-event period, although uncertainty in the cloth industry still remained. For the beta graph, before the event, beta was negative around negative 0.277, meaning the stock moved opposite to the general market trend and had lower market sensitivity. After the event, beta remained close to zero at around negative 0.015, indicating weak correlation with market movement and lower systematic risk. Overall, weak investor sentiment and market uncertainty continue to influence stock cloth performance. In conclusion, the war event had a negative impact on Top Glove Corporation Berhad. The company's stock price, abnormal return, and cumulative abnormal return generally show declining and volatile movement after the event.
Precious Metal Aluminium Holding Berhad is Southeast Asia's largest integrated aluminium producer and one of the major companies listed on the FBM KLCI. The company is well known for using renewable hydropower in Sarawak, which help reduce production costs and lower carbon emission compared to many global competitors. Precious Metal also has strong vertically integrated operation, allowing the company to maintain stable performance even during periods of economic uncertainty and rising energy price. During the 2026 global supply crisis, the company benefit from higher aluminium demand and rising market price, which strengthen its market position and increase investor confidence. Overall, Precious Metal is recognized as competitive and sustainable aluminium producer with strong long-term growth potential. Okay, for the stock graph for the Precious Metal, let's look at the pre-event phase. During this time, Precious Metal share price was remarkably stable, trading narrowly between RM 7.49 and 7.70. At its peak, market sentiment remained calm and global commodity risks were not yet priced into the stock. Okay, moving on to the post-event period, we saw an immediate shift. The price dropped sharply to a low of RM 7.13 by late February. However, this was a short-term reaction. By mid-March, the stock staged a strong recovery, climbing back to 7.77 as investor confidence returned. What drove this movement? First, the stock is highly sensitive to global aluminum price and energy costs. Second, while geopolitical shock costs and initial dips, Precious Metal's strong financial performance act as safety net. This combination of solid fundamental and market demand effectively reduce volatility and fuel the price recovery. Okay, moving on to the daily return graph. Before the event on February 28th, during this phase, Precious Metals saw moderate fluctuation, generally staying between negative 2.21% and 1.97%. Despite a brief dip on February 27, the overall pattern showed a normal market behavior with very limited volatility. After the post-event period, everything changed after the event that return become much more volatile, with frequent swing between positive and negative value. For example, we saw a sharp 4.10% decline on the March 9, followed by strong 3.38% gain just a few days later. This tells us the investor become far more reactive and sensitive to new information. Okay, for the key driver, the core driver here is sensitivity to global aluminium price and rising energy costs. Additionally, geopolitical uncertainty forced investors to rapidly reassess risk and adjust their portfolio. Essentially, the event transformed a stable trading environment into a highly dynamic and uncertain one. Alright, moving on abnormal return graph. Initially, precious metal abnormal return were stable, moving closely with the market expectation. However, the geopolitical conflict in February 2026 triggered a massive supply squeeze, removing 9% of the global aluminium production. For the post-event, the stock significantly outperformed the market, which abnormal return peaking at a 2.50%. Our beta sensitivity also jumped from nearly 0 to 1.01, showing we became highly responsive to the surging commodity price. Ultimately, because the precious metal operate outside the conflict zone, using stable hydropower, it acts as safe haven proxy. This allowed the company to be primarily beneficiary of LME price soaring above 3,400 USD per ton.
This slide shows the total abnormal performance of precious metal. Before the event, precious metal performed really well and demonstrate a fundamental strength. A sharp volatility cumulative abnormal return that reaches a low of negative 104.70%. This gives all the investors extreme panic. But after the event, precious metal goes to a dramatic shift from risk aversion to strategic evaluation. The cumulative abnormal return jumping to 2.08% on 2 March and climbing steadily up until 19 March. The cumulative abnormal return trend after the war regained investor confidence, but the price of aluminium got affected extremely high. Investors see precious metal is safe during the global supply chain crisis. This standard deviation graph shows a significant comparison between those two dates. Before the event, they experienced a significant price movement up until 2.12%. It consistent with the extreme volatility, market was reacting with high uncertainty. After the event date, figure of 1.72% indicates that while the panic subsided, the stock remained volatile and the market is struggling to find new equilibrium. The share price of precious metal was heavily influenced by the sudden surge in London Metal Exchange. During that time, precious metal experienced periods of elevated risk, geopolitical uncertainty increased investor panic, and rising LME aluminium prices caused valuations uncertainty towards the investor market. Beta graph shows a clear differences between the dates. It shows that during the pre-event period, beta of precious metal is approximately negative 0.01. This indicates that precious metal stock move independently. This is because precious metal is lack of correlation behavior during that period. Stock price was driven more by internal company fundamentals than by broader index volatility. By early March, the beta unexpectedly turned strongly positive at 1.01, and the stock begins to move in the same direction as the market. This beta indicates that precious metal is moving in near perfect synchronization with the overall market's volatility. The conflict that happened in the Middle East increased market-wide volatility. Because of this, the aluminium prices went up and it strengthened precious metal market sensitivity. Because of that, investors treated precious metal as commodity-driven market proxy.
And the last company is Hartalega Holdings Berhad. Hartalega Holdings Berhad is the world's leading metallic roof producer. Founded in 1988 in Malaysia, the company now exports products to over 70 countries. Their diverse production line produce medical, industrial and specialty roof. Furthermore, the company is listed on the main board of Bursa Malaysia. Now let's look at the daily stock graph. During the pre-event period, Hartalega's index remained relatively stable, ranging between 0.8550 and 0.9450. Price movements were moderate, reflecting normal market activity. In the post-event period, on 28 February 2026, trading activity eventually halted with return record at 0%. Following the event, the price climbed to a peak of 0.9650 on 30 March. The latest stabilization allows 0.9400 suggests investors reassess the long-term impact of the geopolitical crisis. As a key insight, Hartalega's price shows a strong upward reaction to the geopolitical event as investors appear to move capital into the company as a safe haven asset during the initial stage of the conflict. For the next graph is about daily return graph. In the pre-event period, daily return fluctuated between negative 3.23% and 6.98%. On 10 February 2026, the stock recorded a significant 6.98% gain, indicating active trading and strong investor confidence in the pre-war window. During the post-event period, daily return became significantly more volatile. On 30 March 2026, return jumped to a peak of 11.56%, while on 17 March 2026, returns fell sharply by negative 2.62%. This massive movement were likely driven by war-related uncertainty and shifting demand in the global growth market. The key insight here is that the war event triggered extreme fluctuation in harta lega's daily returns. Investors with speculative buying, potentially viewing growth manufacture as a defensive sector during global instability. Next is about abnormal return graph. For the pre-event period, abnormal returns were mostly stable, though they reached a height of 7.19% on 10 February. This shows specific investor optimism regarding the company's performance even before the major event. In the post-event period, abnormal returns become highly volatile after the event day. On 30 March 2026, abnormal returns skyrocketed to the 12.27%. The sharp rise followed by a drop to negative 3.47% on 17 March indicates a period of speculative buying followed by a swift market correction. As a key insight, the abnormal return graph shows a massive temporary market reaction to the geopolitical shock. Now it's about cumulative abnormal return graph. Looking at the pre-event period, the CAR increased steadily, reaching a peak of 9.80% on 19 February. Investor confidence was supported by harta lega's strong market position in the neutrally growth sector. During the post-event period, after the event, the CAR spiked sharply to a high of 13.89% by 13 March. Investors expected higher demand for medical protection due to the global crisis. The CAR eventually moderated to 10.03% as the market became more cautious. The key insight is that harta lega recorded significant positive cumulative gains following the war event, reflecting a belief that the company could benefit from the changed global landscape. Now it's about standard deviation graph. In the pre-event period, before 28 February, harta lega had a standard deviation of 2.69%. The stock was relatively stable with moderate daily fluctuations. In the post-event period, the standard deviation increased to 3.67%. Daily returns moved much more sharply, indicating significantly higher volatility and market risks. As a key insight, the higher standard deviation means that stock become riskier after the event. Investor uncertainty regarding supply chains and global logistics cause larger price swings. The last graph of the harta lega is about beta graph. In the pre-event period, harta lega had a beta of 1.2845, meaning the stock was more volatile than the overall market and tended to amplify market movement. During the post-event period, the beta fell drastically to 0.0566. This indicates that harta lega stock almost completely decoupled from the general market movement. The key insight is that investors view harta lega as a unique play during the crisis. While the broader market may have been falling or volatile, harta lega's movement become independent, making it a safer or non-correlated asset during the peak of the uncertainty.
As the conclusion, the results show negative return and higher volatility, meaning investors become more cautious. Since these companies operate in several countries, they are more affected by global disruptions. In short, the war increased both uncertainty and risk in the market.